All right. Anyway, thanks for joining us today. And the talk is, avoiding mental whiplash, how to manage conflicting advice. So let me just kind of dive right in. All right. So I'm actually not going to spend too much time. This is typically my intro slide. I'm going to come back to this later. So I'm just going to kind of, but as Allison said, I've worked with CMU startups a long time and a lot of experience in the sort of early stage startup and accelerator community. So really the premise of this talk is that founders, and really you should think about this, I've geared this talk towards founders, people starting companies, but I think this can apply to, you and your career, whatever area you're going into. I mean, you get a lot of advice and that, it's important, right? I mean, because building a network is really important in that whether you're trying to meet investors or just kind of meet people who can give you some guidance on what you're working on, you need to build that network. And of course, the programs here at Swartz are a key part of that. And again, if you go through the McGinnis competition, you're going to need, you get assigned a coach. If you get into the Venture Bridge Accelerator program, there's a whole focus on mentors and sort of mentor matching. So those, it's really important that you do develop that network. That being said, yeah, that network is powerful and valuable, but everyone has an opinion, and that advice can be contradictory. So this is something known as mental whiplash. Have you all ever heard of that term, mental whiplash? Is that new? It's just the idea that, look, if you're standing there and you've got, three or four people tell you what to do, trying to kind of respond to different pieces of feedback, can give you kind of whiplash, kind of with your neck. So let's go through a few examples, right? And these are all things that over the years, startup founders have kind of said to me that either the contradictions or seemingly contradictory things they've heard, right? Sometimes, people say, if you're going to start a company, you have to have a big market, a big vision. And then at the same time, you try to share that. And then, the next investor will say, you need to focus. You need to focus on a niche and execute. Or it's kind of along those lines, hey, you have to have that beachhead market, figure out that initial market you're going to penetrate, go and get customers. And that's too small a market, and usually these are conflicting advice from different people, but I've also heard of examples where sometimes the same person might come back, the next time and give advice that seems contradictory. This is a kind of famous one, and definitely famous with Y Combinator, right? Do things that don't scale. The idea that, hey, early on your startup, really just kind of make things happen. Don't worry too much if it scales. And yet, a lot of times you'll get an investor meeting. How are you going to scale this company? You have to build a strong advisory board if you're going to get funding. Advisors really aren't that important. Advisors care more about your core team. So hopefully, I don't know if any of this is resonating with you or these are things you've heard. IP is critical, intellectual property, patents. You got to really make sure you have a patent strategy. Patents aren't as valuable. Focus on other barriers to entry, like data moats or something like that. So anyway, those are some of the examples just to illustrate this potential contradictions. Is there any ones that you've heard that you want to kind of add to this? All right, that's all right. Keep thinking about it. I'll keep going. So I think if there's one word from today's presentation you take away and that you remember, it's really context, right? I mean, so that's ultimately the key to a lot of these different advices you're going to receive. So let me go a little bit more into that. Why context? Well, and this may sound like the advice you get is both right and wrong. And then the key is how you kind of take in that advice, how you qualify it. So you basically understand that advice and then how you kind of absorb it. So then, in terms of context, these are some of the areas you can think about the context. You have to think about the advisor, so the person giving you the advice. what are their assumptions behind their advice? Because again, any advice that you're given, the person on the other end is, they've got some assumptions or some framework that they're working under. So you have to understand that. And then also make sure you're always applying it to your current situation. So I think that's what we're going to talk a little bit more about. So three dimensions to consider. So the three dimensions to consider for context, sector, market conditions, and stage of company, that is. So let's first take sector. This is a general term I use for your type of business and maybe some key dimensions where it's different. And if you ever are doing searches in PitchBook, looking or just anything where there's companies categorized, sometimes they're categorized by industry, healthcare, financial services, manufacturing. Sometimes they're categorized by the type of technology, IoT, robotics. Also, business model, whether it's software as a service or like a physical product like medical devices, or if it's maybe more of a e-commerce type of solution that has transactional revenues. These are all different examples of different types of business models, really. And then, there could be even finer distinctions, right? Whether the company you're building has a regulatory pathway, needs to get FDA approval, how you acquire customers. Are you using a direct sales model? Are you hiring people? Is it all sort of online? Is it product led where really you're just having folks maybe discover your product and sign up? So those are all various differences that kind of go into the type of company you're building. Second is market conditions. And I think this one is often overlooked or maybe underestimated. And it's very important to this discussion that the time and location can also kind of vary in advice. So some examples, whether we're talking about the late 90s, 2008, 2021, 2024. As I point out, like 2021, in the venture market, I think there was a lot of companies sort of funded towards the end of, up till the end of 2021, there was definitely a growth mindset with funding, larger funding rounds, higher valuations. And then there was a sort of a turn in the market where a lot of those companies that had been valued very highly up until 2021, then it was different conditions for raising more funding. And actually a lot of those startups, even though they still had hundreds of millions of dollars in the banks, actually then did layoffs and cost cutting because they then had to adjust their business for the new sort of funding conditions. And then, overall funding environment, is it bullish or bearish? And also for your sector, and actually I should add for your stage, there are times where the funding is still quite robust and there's a lot of activity in the seed stage, but Series A, Series B companies, are having a hard time raising money. Or, in the last couple of years, what I've heard is, like AI companies, have had more favorable tailwinds, but other companies haven't. But then even within AI, then, I think it depends on what type of AI company you're building. So I think those are all examples. And in geography, I think giving advice on how to raise funding here in Pittsburgh, there are some similarities, but also differences for if your company was located in the Bay Area. And those are just kind of realities. So these are all things just to kind of think about, and really all fits under a theme that, not all advice, kind of fits all. Stage, and I've sort of alluded to stage of company, right? It's another big driver, but really different strategies are needed at different stages. And if you go back to those contradictions I shared at the beginning, a lot of those are probably differences based off what stage of company you're at, especially like scaling, for example. If you're at the very early stages and you're just getting started and you need to prove out that your product works or that you can get at some customers, then most investors would say, I care less about your scaling strategy. I just want to prove that this thing's worth scaling. But if you get beyond that, and now you're trying to raise money to build a sales team, a marketing team, then, I want to make sure that this thing can scale. So yeah, I just kind of talked about that. Example is around customer acquisition, the manual getting customers versus building a repeatable process. Similarly, at the earlier stages, expecting that the founding team is going to do the sales. I remember when I was sort of looking at companies for investment, I had a company, the two founders said, hey, we're having a hard time getting sales. We need investment so we can hire a VP of sales so that they're the professional, they can get sales. And we said, no. It's like if the founders can't really make those initial sales, I think there's more of a question on, do you have product market fit, or do you have something that really the market wants, as opposed to, a VP of sales is great at coming in and helping this kind of scale and grow your sales, but for the initial sales. So that's another distinction. Similarly, development, I think there's different philosophies about whether you can outsource it to a development firm versus you need to build it in-house. And that may depend on your sector, how important it is that you kind of own that core IP. A lot of companies probably will outsource some parts of their development that aren't as proprietary, but then certain types of expertise they need to keep in-house. So I think, when you're evaluating the advice you're getting, right, keep these dimensions in mind. And I think I talked about this earlier: the advisor, the assumptions, and your situation. So let's go back to my intro slide. Who am I, right? And pretend you're starting a company, let's say a medical device company. All right. So you're trying to figure out, okay, you're evaluating me on the context, the advisor. Let's say I was, introduced to you as an advisor or a mentor. You've got to then figure out, like, how relevant is my feedback for you? So then you look for clues. I mean, so I'm just going to show you here in the bio. So if you look at it from a sector standpoint, you're trying to say, okay, does this guy know anything about medical devices? Does he have any experience in sort of health or life sciences? Just clues here, right? Okay, I was involved with Alpha Lab Health. I've done some stuff with software companies. Some of the companies that I've worked with are in the or that invested in are in the life sciences stage. But I should also be telling you that that's not really, I mean, I have experience and exposure to that, but that's not where I have deep expertise. I've evaluated companies at a general level, at a sort of early level in that area, but that's not where I'm going to be able to go deep. And actually, if we go market conditions, and this is sort of aging myself, you also have to look at, all right, sort of time frame. Of course, I'm not going to put this in my bio, but you should look me up on LinkedIn and try to get a sense for how current is the device, and again, what are those conditions? What was in Pittsburgh? What was in California? And I think the key there is, and I tell founders this now, I get, sometimes people ask me, hey, can I pick your brain about funding? And I say, sure, but please be aware, I have not actually actively looked at companies for investment in about a year and a half since I joined CMU. So therefore, I'm going to give you general advice and feedback, but you've got to then go to other sources to find out what the current conditions are. I can give you maybe some general frameworks and ways to think about your business, and can tell you maybe a year ago how I would have evaluated your business, but with the caveat that that may not hold today. And then same stage, right? So what stage of companies have I worked with? Okay, I'm running corporate startup lab now for CMU. So kind of more experience with the larger corporates. Started accelerators is pre-seed seed stage. So that kind of just gives you a sense for, and let me tell you, the stage that an investor worked at is really important. If an investor has really only done Series B, Series C companies, they're used to writing $50 million, $100 million checks, and companies that have already existing revenues, that's very different from, say, a pre-seed investor or an accelerator, because they're just looking for different things and different criteria. So I think, for any advice, sort of understand the following. So this is for you as you are seeking advice. One is, don't just take the advice. Don't let me just tell you should do this. Ask me why. Or have me understand. Explain the context. Now, hopefully if I'm a good mentor, I will just naturally offer that, but just, kind of keep that in mind whenever you are getting advice. Again, the assumptions being made about your company or situation. If they are basing off their experience, learn a little bit more. And you could say, hey, tell me more about that. Tell me when you experienced that. And then you're pulling out the context clues. Now, you don't have to make it obvious that that's what you're actually doing. Just kind of, hey, tell me more. And then again, it's those same things that we talked about: the company, the market conditions, the stage. Because I remember there was someone, uh, I remember I was in a meeting with someone who was sort of a mentor to a company, and they kind of gave this advice to the company. It's like, you should always, if you're going to go to a trade show, you should always kind of go big and, invest in the booth, have a presence. That's what we did in our company, and it really worked out. And I remember thinking to myself, it's like, well, and I didn't say it out loud. I told the entrepreneur afterwards, I said, look, just so you know, when they did that, because I had worked with that other company, they had already raised several $1,000,000. They had a product in the market and sales. So, and their model was a B2B model, to try to, get those types of leads. So I think, a trade show investing in it made sense. You haven't raised $2 million. You're in your first 100K. It was just different situation. So I thought it was, and that actually always formed my example for this whole context, talk. So the next section is more around how you sort of manage advisors and mentors, how you get more from the relationship. I mean, I just kind of went through the heart of the talk on, the whiplash part. How do you avoid it? How do you manage it? Are there any questions, either from folks in the room or folks on Zoom? Yeah.
How do you tackle that, right? In that moment, how do you present that, hey, I'm not agreeing with it?
Yeah, I mean, I guess it depends on the situation, right? I mean, in general, I would definitely ask some questions to make sure you're thoughtfully considering and understanding it. I don't know if you're always going to be put on the spot to say whether you agree with it or not, right? I mean, because again, your job is you're collecting data, right? Ultimately, you're collecting data from different sources. You could say, hey, that's, just so I understand a little bit more, can you tell me more about that? And then, it depends, right? You could say, hey, thanks, that's very helpful. I'm going to kind of think about that as I pull together our overall strategy. Or if you feel like, you want to have a discussion with them, you can say, I hear what you're saying, but I feel like my situation's a little bit different. And let me tell you why. And then, see how they respond to it. So I think you're going to have to sort of decide. Now, one example I will give you where it was very specific feedback was given, and the entrepreneur specifically decided to not follow it. The way they handled it, well, this was sort of a startup company that was preparing for their demo day pitch. And the advisor, during a dry run, kind of came out and said, um, you know, I would not, I think the opening was something like, insurance shopping sucks. And that's what the entrepreneur wanted to say. They were trying to really illustrate a problem in the insurance industry. The advisor didn't like that and, came out pretty strongly like, you shouldn't do that. It'll turn off people. And so I think the entrepreneur listened and took that in. But then what they did was, before the presentation, they emailed the advisor and very, nicely say, hey, I just want to thank you for the feedback. I really listened to it. I went out and tested with a few others. In the end, I'm still going to go with it because, it's kind of is what I wanted to speak to, and it tested well with some other folks. And so that was a very, I think, thoughtful way of showing that you valued their feedback and you considered it, but also you weren't, you had decided that you were going to do it your way. So I think that was a good example, I think. Now, that takes more time and more work, but they knew that this advisor was coming to their presentation, and so they were sort of preempted that. And in the end, it was a very I think, happy ending in the sense that it was definitely considered by most people the best presentation that demo day, and they got like multiple term sheets after that. So it was also, and I think that kind of goes along with the idea that sometimes as an entrepreneur, you do have to trust your gut. I mean, and that's actually in one of my slides coming up. Anything else? Yeah, I'm sorry.
What if you have more than one mentor and receive contradicting advice?
Yeah, I think that depends, right? If it's, and we kind of talked about it with organizing a meeting. If ideally, if they're both in the room at the same time, you're facilitating discussion and you kind of let them sort of reconcile that. But or if again, back to if you're getting conflicting advice, hopefully you can drill down a little bit deeper on why that advice might be conflicting, and then you're going to have to decide which one better fits, your situation and maybe your view of things. So, okay, let me go on to this part. It's more given that you're going to have mentors and advisors, what are better ways to kind of manage them and build the relationships with them? First is email updates. I'm a big fan of it. If you get into an accelerator program, you're actually, a lot of accelerator programs encourage you or mandate you that you do regular email updates to your mentors. So I think, the positives, right? It's a valuable way to engage them, and to ask for help. The key though, if you're going to do it, you just got to commit to, I'm going to do this regularly. And you've got to decide, I think often an accelerator program, if it's a 12 or 16-week program, they ask you to do it weekly. You may decide for a given stage of your company that, okay, that's, too frequent. Maybe it's monthly, but try to kind of agree on the cadence. Typically, it contains these, and actually, my next slide, I give you an example that I sort of found on the internet, so you can also look it up, that I think actually captures it. But, you're giving them a quick summary on the company. Sometimes companies get to a point where they've started defining their key performance indicators, KPIs, and then they can show sort of the month-over-month progress. It could be revenues, could be user engagement. It's whatever the kind of key metrics that you've defined. Shout out, thank you to mentors that have helped. That's a way of making them feel appreciated. And also ask, hey, I'm looking for someone that has a connection at this company, or does someone in this network group have expertise on digital marketing, or it can connect me to a firm in Pittsburgh, whatever the ask is. And then this is just the link, but this is, excuse the sort of screenshotting to fit on one page, but if you look at it, this was in Medium. I found it, and I think if you kind of Google email updates to mentors or something like that, this is one of the top choices. But as you can see here, one, it's a pretty short email, so it's not lengthy. Lots of bullet points, easier to read. But the key is, hey, if you look at it, thanks for your support. Section 1, hey, shout out the mentors. 2, here's the revenue, cash and bank, and net burn. So key metrics. And then, I think section 3, oh yeah, wins. So, bullet points of some of the key highlights. 4, struggles and asks, some of the things. And then 5, goals for next month. So this is probably a monthly update. Just to give you an example, and again, I don't think there's one perfect format. It's got to be a combination of, having many of these things and also what you feel like is most relevant for you. And really, it's going to come down to whatever is going to allow you to feel like you can crank this out regularly and consistently. That's probably the best format, and then you can adjust. You can get, early on, you could ask feedback from your mentors. Is there more information you like? Does this format work for you? I think, oh, yes. Yeah, so, oh boy, that's a good question. The question for those online, also investor email updates. So should you combine these two, or should you keep them separate? So I would say, first of all, investors that have invested in your company. So if it's email updates to them, I would keep that separate. I think there, you could probably share a little bit more information. Now I think the content, could be similar, but you might add a section or two. You might add more on your financials or more sensitive things, because especially as investors, if they have certain rights to information. Now, if it's investors that you've met that you want to keep engaged for potentially investing in a future round, the value with including them together in the same email with the mentors is the fact that they feel like you're probably more transparent with them. You're sharing this stuff. You're building a relationship. You're kind of valuing them as mentors as well. But I think I've seen arguments for both. So, and it may be early on, especially if you're in the early stages and you feel like the information you would share with a prospective investor and a mentor isn't that different, then I probably just kind of combine them. But if you find yourself feeling like, maybe it's separate things, because, for example, if you're going to share about fundraising, you could say, hey, we're about to raise our seed round. I'm looking for connections to investors, or I'm looking, for feedback on this pitch deck. Then you've got to decide, okay, do you want to have everyone in the same group or not? So, all right. Second, these are all probably obvious things that you've experienced just in other things you've done, right? But provide something tangible, right? I think it's hard as a mentor to answer more open-ended questions like, oh, what should my go-to-market strategy look like? Or, definitely, the highest levels, what should I do? So, but I think that's harder to answer because now that could be okay if we're spending half an hour together and, you're prepared to sort of then have me drill in a little bit more. And, I would probably ask some questions that starts exploring those context, dimensions. But I think if you're able to give the context and specific questions, it's better. So, and hopefully you can still read it. You might say, hey, here's my current metrics on lead gen by source or by channel. You're presenting them some data. Should I be spending more effort on paid or organic? Or, what does, if you look at my paid acquisition, I'm noticing this. What do you think of that? So the more you can give them some specific, what channels, should I look at for maybe, making a greater investment? How do these metrics compare to others you've seen for a company at our stage with this type of acquisition process? So, if you see there, right, you're leveraging their expertise, which is that they've seen other companies presumably, or maybe it's their own experience, but you're kind of saying for a company at our stage with this type of acquisition process. So by the way you ask the question, you've already put some context. And really, I think if you think about prompt engineering and, getting good prompts for ChatGPT, there's probably a lot of similarities, right? The more specific you can ask those questions to give it context, the better results you're going to get. I think there's probably similarities, here. First drafts, plans or deck, are even better, if you've got something that, you've already kind of done that represents your thinking, kind of getting that feedback. Here's a draft of my go-to-market plans. Can you give me feedback on the following areas? Or here's a draft of the investor share pitch deck I'm creating for my now this is I went into probably too much detail here, but I also wanted, I don't know if you can see, it's at the bottom, but I'll read it. Here's a draft of the investor share pitch deck I'm creating for my network to help get intros with investors. Is there information in there that's too detailed and should be at the investor meeting pitch deck? Again, that's a mouthful. You probably would put that in an email, but I wanted to also highlight that even for pitch decks for investors, there's two types. There's the shared deck, which is probably a shorter version that you would send to your network to try to get interest. So, hey, can you share this to investors in your network and see if, if they're willing to meet with me, versus the I've got a meeting with an investor, I've got half hour, 45 minutes with them. Now I've got a deck, probably with backup slides where I'm going into more depth and details. So that's, I kind of went into a longer version there just to show that even within pitch decks, there's different versions. Another thing is, organize a meeting, get everyone in the room together. So there's some pluses of that, right? It's more efficient. Everyone hears the same conversation, they hear the same context. And then you also have the opportunity where they actually sort of build off each other or reconcile differing opinions in real time. I think this works well if it's a group that maybe knows each other or they've spent some time together. So this is more of a formal advisory team that, they've now kind of all got the same context from working with you, or there's something very tangible for them to react to. So I think an investor pitch deck isn't a bad reason to have a meeting, even if your advisors don't know each other, because you're also simulating the idea that, hey, I have 3 or 4 people, they're going to see the same thing. I want to see what the different reactions are. And that's similar to like if you were presenting, to a room full of folks. So I think you have to think about that. I mean, the caveats, right, is that if they come in with different levels of knowledge about your business or your industry, you don't want to be spending the time educating, one part of the room when the other part of the room maybe is has been with you from the beginning and they don't feel like it's good use of their time. Anytime with group dynamics, you have to think about, is there a dominant voice in the room that's going to, kind of overwhelm the other voices? And it could be that's your advisor that knows your company inside out, that's been with you for a year versus someone brand new, or someone who's a real expert in the industry, and then they'll naturally draw the conversation into that realm. So you have to think about that when you're constructing it. And then again, similarly, try to focus on a specific issue, but it depends on whether this is a group that is more ad hoc or meets regularly. And then I think finally, this might be the next to the last slide, this is more just about the interpersonal side of valuing and respecting their time. It's just nurturing the relationship, recognizing that they're busy, that if they are kind of such that you would want them giving you advice and mentoring, presumably they're busy, that they are doing it with the intent because they want to help entrepreneurs or just kind of mentor folks. But that's also, you still have to be careful that's not an invitation to sort of take advantage. And I'll go a little bit more into what does that mean. So I think one thing is urgency, because as a startup founder, right, everything is urgent to you. Like, you're going, 100 miles an hour. There's all these deadlines are coming up. So you do, that's kind of, what you're going through. You have to think about, you still need to plan a little bit ahead. You can't kind of just transfer that urgency onto your advisor network, so therefore, I don't know, calling or texting them on Sunday evening. Hey, are you available for a call at 11 p.m.? I need to talk to you about this thing. Now, if you have an important call Monday morning at 8, let's just say you have an investor call Monday morning at 8. Now, if you text, a couple of your mentors Sunday night at 10 and say, hey, can you jump on a call with me? I've got this thing. That's still not good planning if that meeting was well in advance. But if you are like going through an acquisition process with your company, and this happened a couple of years ago with a company, a founder that I knew, look, we were on the phone all weekend because there was real urgency, right? They were in real-time negotiations with the acquiring company, and they needed real-time feedback, and we needed to, we couldn't wait till Monday morning because they were having a meeting Monday morning, and we needed a weekend to work through some stuff. So I think that's just kind of keep those things in mind, and a lot of this is just it's just basic interpersonal skills. So don't lose sight of all of that. I think that goes back to the updates, right? That's why the updates are valuable, because you're investing in keeping them updated, showing that you value them, and it makes it feel less transactional, as opposed to, and then you all kind of know, right? People in your lives that you feel like the only time you hear from them is when they want something from you. And doesn't make any of us feel good. And you just want to be sensitive to that, that you're not doing that to your network. And then I think the last thing is follow up. So if they do make an intro for you or they make a suggestion for you, especially if it was an intro or suggestion that yielded something, very positive, make sure you take the time to let them know that and thank them even after the fact, because that reinforces, kind of what they did for you. So sort of parting thoughts, and then, can take additional questions. The good mentors, they should tell you the qualifiers and context with your advice. They should not tell you you must do this, or like this is the only way. In fact, I've often thought that there was the folks who were so absolute, like, oh no, this is what you absolutely need to do. Actually, I always kind of question how good they were. But it's hard, right? Because if you're meeting folks you don't know that, it's you're not sure whose advice you should listen to. I have this one mentor that I would tell companies, like, this person's going to give you what seems like soft advice. They're not going to really tell you what you should do. They're probably just going to ask you a lot of questions. You've got to pay really close attention to the questions they're asking you, because that's valuable insight. I can tell you, this is one of the best entrepreneurs in Pittsburgh. They've started multiple companies, sold them. They're never going to tell you what you should do, but they're going to ask you sort of questions that are leading questions that you've got to then kind of read into that. So that's also, I think, a piece of this equation. Ask qualifying questions. I think we've talked about that. Be careful of absolutes. Obviously, filter and apply to your situation. I think you're getting the theme here. And so kind of finally, right, I mean, it's your company. Or it's your career, whatever's the context, and you know it. You should know it better than anyone, and especially how it fits for you. So just kind of keep that in mind when you're kind of meeting folks and kind of getting advice. So I think that was it. That's kind of what I had. Any other questions? Yeah. So how do you break up with a mentor advisor? Oh gosh, I think there's a couple things. First, you have to make the distinction. Are we talking about, because advisors, there's informal advisors, which I guess, you could call mentors, or there's advisors who are formally with your company that you've actually given some equity to. There's an advisor agreement where, they could actually invest in some of the stock. So those, if you are, and a lot of times, the informal relationships, if you do, at some point, if you find yourself constantly going to the same person over and over again, and they're actually spending a lot of time helping you, you may want to consider asking them to formally be an advisor at a company. And then I think there are agreements out there. There's template agreements for advisors, that kind of specified equity, a vesting period. So I think one, setting up those agreements allows you to have some expectation setting. And then if you feel like you need to break up, it could be, having an honest discussion where you don't feel like the expectations are being met. It could be as you kind of reach the end of a renewal period, maybe it's thanking them for what they've done, but just saying, as you kind of move into this next stage of the company, you kind of, from an advisory standpoint, maybe you're looking for other advisors. That's a harder conversation. So, and the breakups are not definitely my area of expertise. I think with the informal one, it depends, right? It's because a lot of those informal relationships are sort of just mutual, right? It's double opt-in. It's in some ways, it's usually becomes obvious to both sides that, maybe it was good to have a couple coffees and have some conversations, but it doesn't kind of move forward, and then you have to decide, right? Like, that's where the email updates come in. Sometimes when companies or founders are meeting mentors at a meetup, we tell them, well, you could, if you really find that you kind of want to stay connected with them or want to stay in touch, ask them, hey, do you mind if I add you to my email update list? So that's a way of at least getting some opt-in to continuing the discussion. And then, you know, then in some ways, right, if they never respond to your emails, if they never reach out to you, then I don't know if you need to break up with them per se. You know, now you could decide at some point, like, or if you are seeing that they don't even open your emails, at some point you could probably just remove them from your email list. So I don't know if that kind of quite covers it. It's, you know, I hate to say, you know, you kind of need that, you know, the answer is to ghost them, but I do think that sometimes things sort of naturally work out, you know. But I think it depends on the context of how the relationship was set up, because, you know, in an accelerator program, sometimes you get assigned a mentor and there is an expectation that you are regularly engaging that mentor throughout the program, but with no expectations after the program. And so there, you know, sometimes it's been, you know, I've just kind of advised a company like, look, it's including them on the emails. It's a couple of meetings, you know, you don't have to take the advice. So is it worth, you know, kind of the social capital of doing a formal breakup, and then probably then the accelerator team is needing to get involved. Now, obviously, let me say, if there's bad behavior, a toxic situation, you know, or, you know, anything like that, then you want to, you know, say something, you know. So for example, if you're in a program where you're introduced to a mentor and the expectation has been set that the mentors are there, you know, as part of the program to support you, and they're asking you, you know, or they're almost pressuring you to like sign up for consulting with them, or, you know, anything like that, that's out of bounds. So in that case, you probably want to, you know, talk to the folks running the program. So I want to make sure it's clear that, you know, you have to sort of protect your boundaries as well as the mentee or the person who's getting the advice. And if there's nothing else, I mean, I can wrap up here, and then I'll stick around for a few minutes if anyone wants to chat more. But thanks for coming in and for all your questions. And, you know, hopefully this was helpful, and good luck. All right, thanks.